Assalamualaikum warahmatullahi wabarakatuh. My name is Aimi Nabilah binti Makno. Number matric is 11800780, and today's presentation is on the individual assignment of the investment portfolio. So, the purpose of this investment is to generate profit from the capital for several purposes of future needs, such as savings, emergency funds, buying a house, and vacation. The dummy capital of 100,000 ringgit will be allocated, and the return goal for this investment is 15%. The time period is in 1 year, which is from 4th January 2021 till 31st December 2021. The investment capital was allocated into 5 companies of stocks, which are Inari Ametron Berhad, Vitrox Corporation Berhad, RCE Capital Berhad, Petronas Chemicals Berhad, and SP Setia Berhad. The stock companies selected are the Sharia compliance companies, and they are among the companies in the potential industries such as technology, financial services, property, and industrial products and services. The stock companies are being selected because of the current positive and uptrend, which had the potential of future growth, and they have a positive beta, which means they have a positive relation to the market movement. As shown in the table, each of the stocks of companies is allocated 20% of the capital investment in the portfolio. This sheet is where I calculate the daily returns of each stock, which the formula is new price today minus the old price and divide with the old price. I also calculate the average daily return, standard deviation, variance, covariance, and correlation using the formula from Excel. For the annualized calculation, which is the annualized return and annualized covariance matrix, I just multiply each of them with the number of trading days respectively, which is 245. And here is the calculation of the expected return of each stock using the capital asset pricing model. The beta of each stock was taken from the investing.com, and the risk-free rate and risk premium is taken from market risk premium. The value is on October 2021. The CAPM formula describes the relationship between the expected return and risk of an asset, assumes that the riskier asset will yield a higher return. And in this case, the higher expected return is the SP Setia Berhad, and also have the highest beta among other stocks, which is the high beta implies increased risk and high volatility relative to the overall market. For the portfolio optimization, I use the annualized covariance matrix and expected return, which are the annualized returns as calculated before. And here are the equally weighted portfolio, which using the same weights, and the other one is the optimized portfolio after using the solver. The objective for portfolio optimization is to minimize the portfolio risk for the fixed portfolio expected return by changing the portfolio weights. And after using the solver, we see that the portfolio standard deviation, which represent the risk, is reduced, and the weights of each stock change, but the portfolio expected return is still the same. And I also calculate the portfolio beta by multiplying the beta of each stock with the optimized portfolio weights, and the result is 0.85. For the efficient frontier, I also use the annualized covariance matrix and expected return, which are the annualized return as calculated before. And I use the solver for this output to build the efficient frontier graph. And here is the result of efficient frontier, where according to Markowitz, the graph should be curved line and not linear, because it is said that there is a diminishing marginal return to risk. To calculate my final result of stock investment performance, I use the trade fees, which are based on the Kenanga trading platform, and the total cost of each stock allocated according to the optimized weighted portfolio. The total gain of profit I get is 36,540 ringgit and 28 cents for the 5 stocks of the portfolio in the period of 1 year, and I managed to minimize the risk with the gain of 36.5%, which is beyond the expectation of my return goals that have been set up from the early period of investment. For the evaluation performance of the portfolio, we use Sharpe ratio, Trainer ratio, and Jensen's alpha analysis. First, the Sharpe ratio is where it measures the risk premium of the portfolio over the portfolio risk. or its standard deviation. The Sharpe ratio of 2.02 is considered very good because the higher the Sharpe ratio, the better its return has been relative to the amount of investment risk taken. Next is the trainer ratio. It compares the portfolio risk premium to the systemic risk of the portfolio as measured by its beta, and I got the trainer ratio of 0.37. A higher trainer ratio means a portfolio is a more suitable investment, but it does not necessarily indicate future performance. And lastly, Jensen's alpha analysis calculates the excess return that a portfolio generates over its expected return using the CAPM. Jensen's alpha of 29% is considered very good, as the higher the ratio means, the better the risk-adjusted returns. That's all from me. Thank you.